On 17 July 2024, Allianz Europe, or Allianz, announced its preconditional voluntary general offer to acquire the shares of Income Insurance Limited, or Income. I will refer to this as the proposed transaction. As part of the proposed transaction, NTUC Enterprise, or NE, had given a legal commitment to sell a proportion of its shares in Income to enable Allianz to acquire a majority stake in Income. The government has assessed the proposed transaction and has decided that it would not be in the public interest for the transaction in its current form to proceed. Over the years, Income played an important role in providing affordable insurance for workers and Singaporeans at large. NTUC Enterprise was set up in 2012 as a holding entity for the various social enterprises under the labour movement. NE is also a co-op and currently holds about 72% of the shares in Income. In 2022, Income embarked on a corporatization exercise. It wanted to change its legal form from a co-op to a company and to replicate the existing co-op shareholding profile in the shareholding profile of the new corporate entity to be set up. Its reasons were as follows. Income needed to evolve to meet tightening regulations for financial institutions. This required a strong capital base. However, the co-op structure has limitations, and it is not conducive to stronger capital access and good value strategic partnerships. In the face of increasing global competition, Income wanted a corporate structure which would put it on par with its competitors. Income therefore proposed to convert itself into a corporate entity, with the members of the co-op receiving pari passu distribution in specie of shares in the new entity. Income also sought an exemption from Section 88 of the CSA, which applies when a co-op is put in liquidation. Because Income was not in substance being liquidated, it was only changing its legal form and would continue to be engaged in the same business. The exemption was therefore needed to facilitate the corporatization exercise so that Income's accumulated surplus beyond par value could be carried over to the new corporate entity to allow it to continue the business. Following this exemption, Income carried over approximately $2 billion in surplus to the new corporate entity. The corporatization exercise was completed on 6 April 2023. So let me now come to the proposed Income Allianz transaction, which was announced on 17 July 2024. In announcing the proposed transaction, NE and Income had said that it was needed to strengthen Income so that it could continue with its social mission. They explained that insurance is a long-tail business. Income's capital buffers have repeatedly come under pressure over the years. NE has supported Income with capital injections but cannot continue to do so on its own. And that is why Income has proposed this transaction with Allianz to find a strong partner that can complement NE in strengthening Income so that it can sustain its social mission. Income with Allianz and NE had also committed to continue pursuing Income's social mission even after the transaction. In its announcement, Allianz had also said that it intended for Income to continue participating in national insurance programs. It assured the public of a seamless transition for policyholders and said that it would continue to honor the contractual terms and conditions of the existing policies underwritten by Income. MCCY had no prior knowledge of the proposed transaction prior to the public announcements. When we first saw the announcements, we accepted the intent of the transaction, which is to strengthen Income. We saw that Income would be engaged in a strategic partnership with a major reputable player in the industry. This would strengthen Income's capital base and allow it to have more access to capital. And this is consistent with the representations that Income had made to MCCY at the point of corporatization. My colleague, MOS Alvin Tan, also spoke in Parliament in the August session. He explained that MCCY appreciated the competitive landscape that Income was operating in and understood how the transaction with Allianz would help Income achieve longer-term financial sustainability. Subsequent to the August session of Parliament, MCCY continued to do due diligence and inquire further into the proposed transaction, including on the various public queries which had been raised. In the course of this review, MES provided MCCY with further details on the proposed transaction. This included information which Allianz-Income and NE had submitted to MES in respect of initiatives to optimize the capital of income post-transaction. MCCY had not seen this information earlier. From our review of this additional information, we gathered the following. The parties intended to implement a number of initiatives to optimize Income's insurance business after completion of the acquisition. The plan was for Income to run its insurance business more efficiently without the need to hold as much capital as it presently does. As such, post-transaction, Allianz contemplates that Income could reduce its existing share capital and return this capital to shareholders. Allianz projects that Income will return some $1.85 billion in cash to its shareholders within the first 3 years after completion of the transaction. NE and Income focused on bringing in a strong shareholder and believed that even with these initiatives, the proposed transaction with Allianz would allow it to continue with its social mission for years to come. These projections were submitted to MES at around the time that the proposed transaction was announced in mid-July 2024. At that time, MES had reviewed the information based on prudential grounds, focusing on whether Allianz was a fit and proper institution and Allianz's financial strength and track record so that the interests of Income's policyholders would be safeguarded with a strong, substantial shareholder. MES considered the planned capital optimization from a prudential point of view in accordance with its regulatory mandate. Based on the plans submitted, MES did not have reason for concern as Income was projected to continue to meet regulatory capital requirements with a healthy margin, even with the capital reduction. However, after the 6 August parliamentary sitting, MES saw that Income's planned capital optimization could be relevant to MCCY's views on the proposed transaction. MES then shared the information with MCCY, including the terms of the proposed transaction. It was at this point, after MCCY reviewed the information on the proposed transaction, that we became concerned. We decided that there was sufficient basis for the government to intervene in the proposed transaction to protect the public interest, notwithstanding that the financial prudential requirements had been satisfied. First, we find it difficult to reconcile the proposed substantial capital reduction soon after the transaction is completed, with Income's representations to MCCY during the corporatization exercise that it was aiming to build up capital resources and enhance its financial strength. As I had explained, as part of that exercise, Income had sought and obtained an exemption to allow it to carry over a surplus of $2 billion to the new corporate entity. The proposed capital reduction runs counter to the premise on which the exemption was given. If not for the ministerial exemption in 2023, Income Co-op's accumulated surplus of some $2 billion would have gone to the CSLA after being wound up, to benefit the co-op movement in Singapore as a whole. MCCY has not seen any arrangement within the present transaction to account for the estimated $2 billion surplus that was carried over to the new corporate entity due to the exemption. There is no clarity on how this sum will be directed towards advancing Income's social mission. Second, MCCY is not satisfied that Income will be able to continue fulfilling its social mission after the proposed transaction. There are no clear binding provisions or structural protections in the deal to ensure that Income's social mission will be discharged. It is also not clear what Income might do after the capital extraction, for example, to adjust or trim its insurance portfolio, and what impact this could have on policyholders. NE has stated that it intends to maintain Income's social mission. MCCY accepts that NE is making this commitment in good faith. But MCCY is not confident that NE's intentions or the assurances Income gave earlier to MCCY can be upheld. We had known earlier that the proposed transaction would leave NE as the minority shareholder in the new entity, with a minority of board positions and no ability to nominate the chairman of the new Income entity. On their own, these factors would not have caused MCCY to object to the transaction. However, taken together with the proposed capital extraction and the lack of structural protections in the deal to ensure the continuation of Income's social mission, cumulatively, they pose a risk that MCCY judges not to be acceptable. Our concern is only over the terms and structure of this specific transaction, particularly in the context of the preceding corporatization exercise. Income was a co-op and subject to the objectives and obligations of being a co-op. Therefore, we also have to take into account the circumstances in which Income was corporatized and obtained an exemption from Section 88 of the CSA. Hence, our assessment of the viability of this transaction must go beyond prudential considerations alone. Whilst we will not allow the proposed transaction to proceed, we are nonetheless open to any new arrangement which Income may wish to pursue, whether with Allianz or any other partners, so long as the concerns highlighted are fully addressed. As Income is now a corporate entity, it is no longer subject to the jurisdiction of the Registrar of Co-ops. The approval or otherwise of the proposed transaction now rests with MES under the Insurance Act. Sections 26 and 27 of the Insurance Act require a person to seek the prior written approval of MES to obtain effective control or become a substantial shareholder of a licensed insurer incorporated in Singapore. The proposed transaction therefore requires MES's approval to proceed. When MES assesses an application under these sections, it considers a range of criteria on prudential grounds, such as the financial strength and track record of the applicant and whether it is fit and proper. There is currently no provision in the Insurance Act for MES to consider the views of MCCY in the case of an application relating to an insurer that is either a co-op or linked to a co-op. We therefore intend to amend the Insurance Act to provide a clear statutory basis for MCCY's views to be considered in any approval involving such applications. The amendments will be scoped specifically to only apply to a licensed insurer that is the subject of an application under Sections 26 and 27 of the Insurance Act, and where the licensed insurer is a cooperative, has acquired the business of a cooperative, or has a substantial shareholder or effective controller which is a cooperative. This is based on the government's recognition that insurance co-ops are a special category of insurers with a social mission for which the views of the minister overseeing co-ops need to be considered. The bill will therefore provide for the minister in charge of MES to consider the views of the minister responsible for the administration of the CSA, and for the minister in charge of MES to withhold approval to such applications if he considers that it is in the public interest to do so. Following this ministerial statement, Minister Chee Hong Tat will table the first reading of an amendment bill to the Insurance Act on an urgent basis. Given the time sensitivity of this matter, the second and third readings are proposed to be taken on Wednesday, 16 October 2024. I should add that MCCY may also consider future amendments to the CSA to give the government stronger levers over co-ops that may wish to be corporatized.